Well, this week we're going to look at inflation and what our expectations are. Are we going to get inflation? Are we going to get the Fed target on inflation, or are we going to get deflation? And depending on who you listen to, there are stories for all three that, well, inflation will be benign, but it'll be there, to, well, it'll be outright deflation, to, oh, we're going to get massive inflation. Whenever we tackle a topic this big, you need some framework in which to think. Because if you don't have any framework and you start thinking about inflation, there are so many things that you can look at. And unless you have some structure about how all these variables come together, you'll end up with a very disjointed story. So we'll start with a very simple framework that we've seen in level 1, if you're at level 1, or if you have the archive for level 1. Reading 14 from 2020, section 3.12, introduces something called the quantity theory of money. And reading 15, section 3.2, sets out the argument between the monetarists and the Keynesians about inflation, particularly referring to the quantity theory of money. Now, before I jump into this, a word about economic models. It is typically the case when you introduce economic models in undergraduate courses that students feel uncomfortable with them. And the common rejoinder that you hear is that the world just doesn't work this way. It's far more complex. People don't behave like this. For a lot of economic models, it's true. A model is a simplification of reality, because you have to simplify the complex to be able to begin to think about it. You can't just start with a complex topic. You must bring it down to a simplification, and then you can build complexity slowly upon that. We don't judge a model by its coherence with reality. We judge a model by its usefulness. Is this a useful model in which to think about inflation, in which to think about some big variables like money supply and inflation? And it turns out that this is a very useful model. There is no disagreement on the model itself. The big disagreement comes right here. See these little straight lines over the V and over the Q? That denotes fixed. That's where the disagreement comes in. The monetarists will argue that those variables are fixed. Keynesians say, why, you out of your mind? You're high? They can't be fixed, and they have a good argument why it can't be fixed. So let me lay out this model here. M times V equals P times Q. M is the money supply. And there are lots of different measurements of money supply. M2 is the common one used. However, there are some criticisms of using just M2 because it weights every component identical. It assumes that all the components of money supply are perfect substitutes. So there is something called divisia money supply. On the very, very last screen, I will lay out what divisia is. It's technical, so if you're not interested in the technical definition of what it is, you can move on. The reason that is sort of being slowly more and more embraced is that the relationship between money supply and the price level has sort of been lost in the last decade. Precisely because the components of money supply are treated like good trade-offs to each other as perfect substitutes. But if you weight them, you find that relationship comes back in line, so that if you're looking for pressures on price, you would look at divisia money supply and not just money supply. Again, very technical stuff. Most of this stuff isn't in textbooks. If you want to find more about it, I'll give you some references at the end, but it's mostly academic journal stuff. V is velocity. This is how many times money changes hands in the economy. So if I have $1 and I spend $1 with somebody and they spend $1 and they spend $1, $3 have been spent. So money supply is 1, velocity is 3 because it changed hands 3 times. We would expect that the total amount purchased in an economy is $3, which is what the other side is, price times quantity. And Q is real GDP. P is the price level. So if we take price level multiplied by real GDP, we'll get nominal GDP. So money supply times how many times it changes hands is spending in the economy. This is how much is spent in the economy, and it should obviously equal nominal GDP. Very simplified. If you're going to criticize it on its exactness, yeah, you'll poke holes in it. That's fine. But this is at a high level, a very simplified model. We're going to see if it's useful. And looking at the variables, bringing inflation, thinking about inflation in terms of these four variables, we're going to find is quite useful. That we could get better numbers, but as long as we know the general direction of where something is going, good enough, let's head in that direction. We can add complexity as we go along, but I just want to know, am I going this way or am I going this way? This is useful to get there. Let's look at the argument between monetarists and Keynesians before we jump into this, because if you are a monetarist, you're going to be very interested in the money supply, and your argument for inflation is going to be the massive growth of the money supply. Whether you look at M2 or Divisia M4, which again at the end of the technical slide at the end I'll explain that. You believe that velocity tends to be fixed, that money changes hands. Yeah, it changes a little bit. Monetarists will say, well, it's not fixed. I mean, V is 2, but it could be 2.1, 2.2 in good times and down to 1.8 in bad times. It fluctuates in there, but it's not enough to explain the change in the price level. So they say, well, since it's insignificant in its explanation of a variable, we'll call it fixed. And same with Q, the real GDP, potential real GDP of the economy. That tends to be fixed in the short term. In the long term, you can always add capacity, but that's with a lag, so you tend to have a fixed supply. And if V is fixed and Q is fixed, an increase in M, since this is an equality, must increase P. And Milton Friedman said, inflation is everywhere a monetary phenomena. You increase the money supply faster than the rate of growth of GDP, you only increase the price level, you do not affect the real economy. So that for the monetarist, it's enough to look at money supply. And if you look at money supply, you're buying gold, you're buying Bitcoin, you're buying everything else, and you're saying there's going to be massive inflation. But listen, money supply has been increasing. I'm going to show you charts on the next screen. Money supply has been increasing for a while. Where's the inflation? Right? There is a problem with money supply increasing. It is increasing, there is no question about that, but it's not finding its way into the real economy. So something is wrong in that equation. The Keynesians say, look, money supply times velocity equaling price times quantity, sure, we'll go along with that, we agree with that, but get rid of those bars. Velocity is not fixed. And Keynesians will point out that velocity has been dropping since 1998, and it has. We'll look at a chart of velocity and we'll see it's been going straight down. So that means you need bigger and bigger money supply with lower and lower velocity just to keep nominal GDP constant. So the money supply has to grow just to keep GDP constant. You're not going to get price pressure by increasing the money supply if velocity is dropping. So you can increase M all you want, but if V is dropping, you're not going to get a change in P. Not only that, Keynesians will push back and say, Q, fixed? No, it's not. Companies, especially if you have industrial capacity running around 75%, Q is not fixed at all. You can ramp up in, production with all that unused capacity with no time. If unemployment is very high, you can always hire people to put out more output. It is not fixed. Endogenous growth theory tells us that advances in knowledge increases productivity, and that can increase the amount of output that an economy can produce. So Keynesians would say, look, you get rid of those two bars over V and Q and we're with you. And monetarists say, but no, money supply only. And we'll take the Keynesian, at least I take the Keynesian view on this one, and I'll lay out the argument for it. That we want to, the variable of interest here is not the money supply. It's velocity that's important. Money supply, I find, is an uninteresting variable, and I'll show you why I think it's uninteresting. So Keynesians here are saying V. V is what you want to look at. It depends on economic variables. It's not fixed. It depends on consumer confidence. The more confident we are in the economy, the more willing we are to spend today's money, because we think tomorrow's just going to be better for us. We'll have higher wages, our savings will happen, our 401ks, our retirement plans will grow, our investments will grow, so I'm okay spending. So my marginal propensity to consume might go from 90% to 95%. Interest rates. The lower interest rates are, the more I'm willing to get move out of the apartment, buy a house. Of course, I got to fill it with furniture. I might be willing to trade in my vehicle on a newer vehicle a year or two earlier than I wanted to because I want to take advantage of low rates. So that will bring some consumption forward to today. Unemployment. The lower unemployment is, the more people that have money, you're going to get a rise in wages. That rise in wages makes people feel good. They begin to spend as well. Velocity increases. Same with wages. Even if unemployment doesn't move, but wages increase. More money, people buy more stuff. People buy more stuff, money changes hands faster. You can get an increase in velocity. That all sounds very good. So what do you believe? Do you believe that velocity is fairly fixed in a tight range? Or do you believe that it depends on economic variables? Milton Friedman, not a dumb guy, came to the conclusion that it was fixed. So clearly there must have been some argument for it, and in his time, he was right. So let's have a look at some charts. All right, I've got 3 charts up here. Don't worry about how complicated they all look. I'll go through each one. The bottom one over here is real GDP, and each one is on a different screen. There's real GDP. The next one is money supply. I've written inflation in across here, so we'll pay attention to this when we need to. These are all in decades. So here's our money supply. You can see money supply increasing in each decade. I gave you a percentage of the increase. Same with real GDP. And the top screen up here, this is velocity. And we can see if we take a point up here and you just look at velocity coming down here, since 1998, the velocity of money has been dropping. So even though money supply has been increasing because the velocity has been dropping, we shouldn't expect to see a lot of pressure on inflation. And we can see that if we look at inflation over the decades. Throughout the 80s, the average inflation rate was 5.19. The 90s was 2.7. The noughts were 2.8. And from 2010 to present, 2%. So inflation has been dropping consistently. Velocity has been dropping. Money supply has been increasing. Where's inflation? Now, from 1998 onwards, with velocity dropping, this is where monetarists would probably say, well, something funny is going on here. If we look at, we'll go back to the first quarter, January 1st, 1980, velocity 1.869, and you go all the way to the last quarter of 2001, velocity 1.98. In fact, you could probably just draw a line through here and say, that seems fairly constant. If you were talking about time series, you'd say it looks covariant stationary. You got some serial correlation in here, but variance-wise, it seems to be fairly constant within a range. I can see, and if you go back even further, you'll find that it was fairly constant in and around 1.8 to 2. So when you observe something for a long period of time that's constant, you come to the conclusion that it's constant. That does not mean it won't change in the future, and it has changed. Or we will see, has it? Has it changed? So if we think about velocity, all we've done is taken m times v equals p times q, and we've isolated v to one side by dividing both sides by m. And if we take p times q over m, so we can calculate, at each point we can calculate velocity by taking the average price multiplied by the quantity and dividing it by the money supply, and that'll give us velocity. If we have a denominator that's increasing, you can get velocity dropping. If P and Q remain unchanged, and you simply increase the money supply and P and Q remain unchanged, velocity will drop. Well, that's what's going on over here. Velocity is dropping. We can see that real GDP is increasing. Q here is increasing. It has increased in every decade. The 80s was 2.9. The 90s was great, 3.28. Then you had 1.83 from 2010 to 2019, 2.29 or 2.3%. Real GDP somewhere between 2 and 2.2%. That would be sort of a consensus view of most economists. If you really push it, maybe 3.5%. Capacity utilization right now is low, so you probably could get it that high. Once you hit 3.5–4% on real GDP growth, most economists would say that's really pushing it. So when we look at the 80s, for example, you had 7.45% increase in the money supply, 2.9% increase in real GDP. We would expect that inflation would have probably been significant at that point in time if we believe the monetarists. If V was constant, and if we look over that decade, 1.869 to 1.839, we could say that V was fairly constant in the 80s. Real GDP was 2.9. Money supply growth was 7.45%. We should expect high inflation. Well, what do we have? We have 5.19%. And you're not going to get exact. If you take the 2.9 and you add it to the 5.9, there's something, well, you should get close to the 7.45. Well, you can see that, you're in and around there without me breaking out a lot of the numbers and cleaning them up and getting very precise year by year. Well, there we are. Let's look at the next decade, the 90s, 1.839 to 1.985. Velocity did expand a bit, and because velocity expanded and the money supply expanded, not as much as the 80s, but 4.75. Inflation moderated, 5.19 to 2.7. I should see real GDP higher. And what do? 3.28. I do see it higher. See, so these variables, these four variables, are quite useful in their relationships with each other. They do actually hold in a broad sense, so they are useful. So let's go all the way to 2010 to 2010 to 2020, and there is the beginning of 2011, January 1st, 2011. There's the end. We had 1.726 down to 1.427. Velocity really decreased. In fact, if you go back just 1 year before the recession, velocity was 1.976. 1.976 all the way down to 1.427. Velocity decreased incredibly. We did have an increase of 2.2% in real GDP. Look at the money supply growth, 6.11%. If velocity had stayed constant, I would expect to see a lot of inflation. But velocity dropped. What's it going to do? This is velocity now. Here's inflation, right? If I drop velocity, look what happens to inflation. I should see a low level of inflation because velocity dropped. I see 2%. Lower than the 2.8%. This was at 5.7% monetary growth. This is 6.11. Money growth increased. Inflation decreased, primarily because velocity really decreased. So, you can look at the money supply. If you assume that velocity is constant, you just have to look at the money supply, and that'll give you some idea of what's going to happen to inflation. But velocity is not constant. What if velocity is dropping as you're increasing the money supply? Well, then the effect on inflation is unknown. If you have an increase in real GDP and you have an increase in the money supply greater than the rate of GDP, but velocity is dropping, well, it depends on which variable is more, but if we see that inflation is dropping, that means velocity, the drop in velocity is outweighing the increase in the money supply. I'm interested in velocity. I'm not interested in the money supply. I'm interested in velocity. Why is velocity dropping? And what can we do to increase velocity? And I'm going to show you what happens when we increase velocity, let's say from, where are we now? We're at 1.42. Let's say we're at 1.4. We'll forecast GDP out 2 years, and then we'll increase velocity to 1.5 and look at what happens. There is inflation. We'll keep money supply. We'll look at what happens to the money supply, but you'll look what happens when we change velocity. You'll find inflation. It's in velocity. It's not in money supply. Okay, so on this screen, I'm going to make the argument that we're not really interested in watching the money supply. We're interested in watching velocity. I'm going to show you what a small change in velocity can do. Let's assume, and we're going to make some assumptions here. Well, we're going to assume the money supply is 5 trillion and velocity is 2. which is really what it was during Milton Friedman's empirical time, the time he was looking at markets. Velocity was fairly unchanged, or as he said, any small changes had almost no effect. It wasn't enough to explain the effect on the price level. Let's make velocity 2. And if we accept the quantity theory of money, P times Q equals M times V, all we have to do is multiply M times V, and we'll get P times Q, which is nominal GDP. We should expect nominal GDP of $10 trillion. And let's say that we're doing a 2-year forecast, and we're doing a top-down forecast. We're going to start with GDP, and we think that we're going to see 4% nominal growth. We think it's broken down into 2.2% real growth and 1.8% inflation, which I don't think anybody would give you a lot of pushback on over the next 2 years. Would say, yeah, you're in around there. You might want to do some scenario analysis with a range other than just 4%, but okay, if you think the middle of the distribution is 4%. So if we have 10 trillion based on a money supply of 5 trillion, a velocity of 2, we should expect a 2-year nominal GDP target of $10.816 trillion. Well, let's assume that instead of the velocity being 2 for the next 2 years, velocity is actually 1.4 instead. Because again, we've seen since we've come out of the great financial crisis, the recession 2008, 2009, velocity has simply just dropped from I think 2007 was almost 2 to 1.4. So let's say velocity is going to be 1.4. 10.816 divided by velocity 1.4, you need a money supply of 7.725 trillion. That's a 55% increase in the money supply. So velocity over the next 2 years was going to drop from 2 down to 1.4. Even if you increase the money supply 55%, you would still end up with 10.816 trillion, which means 2.2 real, 1.8 inflation. Where's the inflation, right? Inflation can stay down if velocity is dropping while the money supply is increasing. We've increased the money supply 55% at a lower velocity, and we're not going to change nominal GDP. But imagine that we went from 1.4 to 1.5. We've increased the money supply 55%. We're at 7.725 trillion. And now we're saying, look, that didn't work out very well. Let's direct policy towards increasing velocity. Let's do that. On the second last screen, I'm going to have a whole bunch of policies that we're going to look for that will increase V. That's what we're going to look for. But let's increase V to 1.5. That's our goal now. So unlike the monetarists, which say, listen, to get inflation, just keep printing money, the Keynesians are saying, stop with that nonsense. You don't have to keep printing money if inflation is what you want. You can do these other things and get your velocity up. At 1.5, if we take M times V, M being the new money supply of 7.725 multiplied by 1.5, we get 11.5875 trillion as a 2-year nominal target. That is 7.64% nominal growth per year. And as I said earlier, if you're assuming 2.2% real growth, yeah, you're not going to get a lot of pushback there. Going to 3, well, that's optimistic. Let's say we push it to 4% real GDP growth over the next 2 years. That's big. Most economists would say, oh, I don't know, that's super optimistic, but let's go there. If you say that it's made up of 4% real growth, it has to be made up of 3.64% inflation. There's your inflation, hiding behind the V, not the M. You get V up just a little, and you will get inflation at these elevated levels of money supply. If you can push V up, you will get inflation because you're not going to push Q up that much on its own. The real growth in GDP is not going to get pushed up that much. There's 3.64. We went from 1.8 to 3.64, but I also said, okay, 2.2, let's push it to 4. If you left it at 2.2 saying, well, no, I think we're going to be at 2.2% real growth, you can see inflation is going to be greater than 5% at that point. There's your inflation. It's hiding behind V. Well, that was useful. If it's hiding behind V, how can I use that to my benefit? Well, before we push on a little bit further, let's see if we can explain what's going on with V and why V is dropping. And I think that these two charts tell pretty much the whole story without getting into a whole bunch of small little detail. We have the Fed balance sheet at the bottom of the screen down here. And at the top of the screen, we have excess bank reserves. If you look at the Fed balance sheet, this is just before the financial crisis. This is about 800 billion. We're somewhere around 7 trillion right now over a period of 11 to 12 years. Significant increase in the bank balance sheet. But look at bank reserves. It was zero at that time. Excess reserves. In other words, reserves held by that banks have with the central bank in excess of the minimum reserve that they need. It's called an excess reserve. Well, look what it's done. And it's mirrored the move. You have the initial jump in the money supply here. You have a gradual growth. You have a sort of a small rolling over and then a major jump. Well, look at this. Excess bank reserves have been following along with the money supply. That is called a liquidity trap, if I can get this to work here. That is called a liquidity trap. So you can increase the money supply all you want. If it's not finding its way into the real economy, it cannot possibly affect inflation. And if you remember that velocity is P times Q over M, well, clearly M has been increasing significantly. Unless the numerator as proportionally increases just as much, V will obviously decrease mathematically. So it's not as if money is changing hands a fewer amount of times. It's just you're counting a lot more money that simply cannot change hands. That if you adjusted for all of that, said, well, let's not count excess bank reserves, let's take that up, velocity would look more like that. Well, probably still a downward slope, but not the way it was. Velocity would be a little bit higher. You can't count this money. This excess bank reserves is not in circulation to change hands. You can't count it. Yes, it's part of the money supply, but it's not really part of the money supply that matters. It's not what the monetarists would say matters. So you can't count that. And that's why using something like divisia money supply matters more, because it puts a weight on different components of money supply. So the weight on this component would be zero. So look, it has no weight. It shouldn't even count in the money supply in this respect. That's why you're getting this lack of relationship between money supply and price, is because you're counting a whole bunch of components that can't possibly make a difference in anything. So if we're wondering, or if we're looking for, well, why is velocity dropping? The other side of the argument that I've heard for why velocity is dropping is a demographic argument. I don't buy the demographic argument. As people age, they hit a certain peak spending, and then their spending starts to drop. I buy that. Yes, there is one generation that is probably dropping in their spending. But there are larger generations behind it that are just beginning to spend. If we look at retail sales, for example, retail sales, a nominal amount of retail sales has been trending downwards for a number of years. Aha, they say, you see? Retail sales are dropping. There's the canary in the coal mine. Careful though. Real retail sales, adjusted for price, have been increasing. In other words, more stuff is being bought, not less stuff is being bought, except they're being bought at lower and lower prices. And this is the result of two effects. Oversaturation in the retail space. When you can walk into a mall and there are 47 clothing stores. 47 clothing stores. No wonder they had to close. And stores have been closing since the beginning of 2018. Well, that's going to lead to pricing pressure on the way down. Globalization. You can make a lot of stuff in other countries, bring it here, suddenly the stuff on the shelves, the price is lower and lower, you can buy more stuff. So we're buying more stuff, we're just buying it at lower prices as a result of globalization and oversaturation in the retail space. We're buying it at lower and lower prices. Combine that with online shopping, where you don't need retail presence, you just need warehouse presence, and a warehouse is somewhere out in the county. Retail is prime space. So suddenly your cost per square foot is significantly lower. You don't need beautiful stores, you just need a warehouse. Suddenly you drive that price even lower. You can order more quantity at lower prices, so you cannot point to nominal numbers and see them trending down and suggest that there's a demographic trend here. You want to look for why velocity has been decreasing, look no further than excess bank reserves. How do you get that out into the real economy? How do you force banks to lend? Will banks lend if you punish them? Let's say that the Fed says, okay, here's what we're going to do. We're not going to go negative on interest rates, but we're going to have a negative interest rate on excess bank reserves. That'll force them to lend because there'll be an opportunity cost. Banks are more than willing to lend. If you bring them customers, if you bring them borrowers with credit quality, they will lend to them. Not a problem. What's happened over the last year, if you look at every bank, is their loan loss provisions have increased dramatically. And then you're going to have a policy that punishes them on their excess reserves. They're going to say, hey, wait a minute here now. You've regulated us in terms of the amount of equity. Remember Basel? There's a certain amount of equity that we need. We have to pass these stress tests all the time. We need this. And now we have increasing loan loss reserves. Now you want us to put more money into these risky assets called loans. Are you going to backstop all of our loan losses? If you are, we'll lend. We'll lend to anybody who walks in the door if you're going to backstop our loan losses. If you're not, get out. Stay out of our business because you don't know what you're doing. So you have to find a way to say, okay, well, going through the banks, we can force the banks to do things, but then we just destabilize the banking system, or we run the risk of destabilizing the banking system. How do we go over the banks directly too? The Fed can start a direct lending program, but does it really want to be in that kind of business? In a screen or two, we're going to see that the Fed really doesn't have a lot of options at this point other than to hold the course. So there we go. This goes a long way to explaining V. M is not the problem to be fixed. M is not going to result in anything at this point resembling what the Fed wants in terms of inflation. M is not going to do it. V has to do it. And we see a problem here. We have a liquidity trap. But we also see a problem with V in that the Fed can lend to banks, but the Fed cannot spend. It lends, not spends. It needs the fiscal. Okay, before we get to what we want to keep our eye out for, let's look at inflation and the different sources of inflation, or the different types of inflation. And in level 1 readings for economics, you will be introduced to cost push and demand pull, and something called inflation expectations. There's another type of inflation called pass-through. This is a result of a dropping currency when you have a large import segment to your economy. So if you're running a trade deficit and you have a dropping dollar, those imports become more expensive. That inflation is passed through the dollar. So lower USD, higher import prices, you will get higher inflation, but that's a rather unsatisfying way to reflate the economy, is to say, well, we'll just give it to other countries. Cost push, especially wages. Wages are the big component of cost push inflation. Not just a few commodities or key commodities going up, but wages, because that is the biggest input price across the entire economy, and it's the biggest part of national income are wages. So if you can get wages up, I don't know that you can do that at a country level without it being the purview of the states or the provinces, and unless they're all on board, it's not going to work out very well, because you'll get arbitrage, right? If Michigan says minimum wage across the state is going up to this level, but Ohio says, well, not for us, then you might have relocation of some jobs out of Michigan into Ohio. So no one is going to play that game unless everybody plays that game. The only way that you can put upward pressure on wages is through the market mechanism, not through legislation, but you can follow some sort of localization strategy, which means the new Biden administration says, we're not going to hurry and remove these tariffs off of China. The damage is done. They did it, not us, but we're not going to go ahead and hurry up and remove them. And maybe they'll come up with some sort of industrial policy that favors localization through, whether it be tax breaks, whether it be, I don't know what else, what else they could do to induce it, but you'd have to have some kind of localization strategy that then uses the market mechanism to push up wages. You might get something there. Demand pull. You got to increase velocity. You have to have something that increases velocity. Increasing the money supply is not going to do it, because you increase the money supply, excess bank reserves go up, and you're no better off than when you started. You have to get it into the real economy, which means you have to find a way to get around the banking system, but you've got to increase V, not M. V. Put an M here, and we'll put a circle through it. This is just not an interesting variable anymore. V is the interesting one. Well, you can look at, to determine where we are, we can look at things like capacity utilization and commodity prices. Capacity utilization, we'll look at a chart of it right now. If it's low, 70, 75%, there's a lot of room to grow within there. Once you get to about 85%, then you have to add capacity. That can be inflationary because there's a demand for construction, a demand for building new factories. And again, commodity prices. You can look at commodity prices as a leading indicator of how much money is finding its way into the real economy. Here is a long-term trend chart for capacity utilization. This goes back to before 1970. 1980 is this big, thick recessionary period in here. But you can see that it's been trending down over the years. Throughout the 80s and 90s, it would bump up against 85%, and then it would sort of drop back. What's going on there is 85% is typically seen as maximum capacity or full capacity. I know it sounds strange. How come 100% isn't? But it's averaged out over a whole bunch of assets. So at 85%, it's considered at full capacity. So more capacity comes online, and as more capacity comes online, the capacity utilization drops because you have big, chunky increments of capacity being added. But 85% is typically seen as full capacity. That's where inflationary pressure really starts to show up. We can see here between 2000 2010, capacity utilization sort of inched a little above 80%. We saw a little bit of inflation showing up over that period of time. If you can remember, to 2006, 2007, inflation was coming in above 3%, above where the Fed was comfortable, which is why it was raising the short-term rate. It seems like a long time ago, but the short-term rate before the recession of 2008, 2009 was as high as 5.25%. I don't think we'll ever see 5.25% short-term rate again, overnight rate. And then between 2010, after the crisis was over, after 2010, we see that it had a hard time even breaking above 80%, and we're sitting somewhere around 73% as of November 2020, sitting at 73%. So capacity utilization has a ways to go before it's really going to start to lead to any kind of inflationary pressure. And again, with unemployment that's elevated, 20 million people collecting unemployment benefits. There's a long way to go. There's a lot of slack in both capacity, industrial capacity, and in unemployment before you really start to get a tight market on either one. So it's going to take quite a lot of real growth in both whatever uses capacity and unemployment before you really start to feel it. So it's nothing that I think, even if you could affect V, you're not really going to have much of an effect until you start to tighten up those two factor markets. The U.S. dollar, a weaker U.S. dollar, the Treasury can do a lot to help out there. I just don't know if it's a healthy kind of inflation. The Treasury is probably going to, repeat the phrase, "We support a strong dollar." However, I don't know how you're going to support a strong dollar and support the White House and Congress and support the Fed all at the same time. You have to support a weak dollar in the short term to help them out of what they want to do. That's going to be tricky, but you want to see the market move and you want to see the dollar move. Listen, pay attention to whenever Janet Yellen is going to be speaking. If she reiterates a strong dollar policy, you're going to get a lot more volatility in the U.S. dollar. But I think that any rally on I support a strong dollar policy can be shorted or faded into any kind of strength on the U.S. only because I made the case for the weak U.S. dollar last time. I don't see any change in my analysis on that. Inflation expectations. This is the Fed's done a lot here. This is the purview of the Fed. How this works to create inflation is you create the expectation that there's going to be inflation, and a lot of business is done on long-term contracts. While those expected inflation levels will be built into contracts, raising prices, thereby creating the very inflation that you said that you were going to create. So if you expect that I'm going to do something, you may begin to act in a way as if I were going to do it, thereby negating my reason for doing it anyways, because you're already doing what I want. And this is sort of a self-fulfilling prophecy, that once you start with inflation expectations and people expect inflation and it starts getting built into prices, then more and more prices will build in expected inflation, and those expectations will begin to climb up, and then it's hard to pull away that type of expectation. But so far, 12 years, increasing balance sheet, very, very low rates for a long period of time, expectations are just not showing up for inflation. So I don't know that this is going to be very powerful right here. This is where you are, and at this point, it is fiscal. Okay. This will be the last screen for this video. The next screen is really just technical. It will just describe what, at a very high level, divisia money supply. The conclusion that I'm arriving at is that monetary policy at this level is now ineffective. It's not going to create inflation. I think Powell knows that, which is why he's lobbying Congress to do something, spend money, please, because I think he knows that, look, more of the same isn't going to really do anything. I don't think that he's going to reverse course. I don't think he's going to shrink the size of the balance sheet. I think, he's already admitted that he's going to keep expanding it, $120 billion a month. I think he's going to have to do more, but he'll keep expanding it. One question I got, which was rather interesting, is what's the end game here? Like, how do you get out of this? I don't think you do. I think, it's being touted as a temporary policy, that this is temporary, and when the problem is gone, we'll put these tools back in the toolbox. I think slowly more people on the committee, on the FOMC, the Fed committee, are beginning to realize that this is a one-way trip. There is no going back from the balance sheet this size. This will just be where it will stay. And if there is going back, it's going to be slow and long. We're talking decades, not a matter of by 2027 it'll be all over. But I think slowly they'll come to the conclusion that why do we have to go back? This has been and will be a one-way trip. We're here now, and this is where we'll stay. Negative interest rates. I don't know that that's going to do very much. You already have negative real rates. So, to have negative interest rates, that's a big dislocation to the system. I don't know that it's going to have, it hasn't had any effect anywhere it's been tried, not to the effect that was necessary, and not any big effect, tiny little effects, but, had you not had negative interest rates, could have you gotten that anyways? Was that just an inevitability of what you were doing? I don't see negative rates. I see, as inflation expectations build, more negative yields. I think the Treasury rates are already have negative yields on them out to, I think, the 10-year. What about just on excess reserves? Punish the banks. Again, you would just be telling banks that, yeah, the environment out there sucks, but go take on more risk. A bank is not going to do that because it has equity levels that it has to maintain. It has certain ratios that it has to maintain. Unless the Fed is say, look, we'll backstop all of your loan losses. Well, what's that going to do? Banks saying, well, if the Fed's going to bank stop it, off we go. They'll just lend profitably and not smart. So I don't think that we're going to head there. I think that's really just trying to do more of the same, and I don't think it's going to have that much effect. Fiscal policy is needed. So why are we going down this road? Why am I talking about the type of policy that's needed? I thought we were going to talk about inflation here. Are we going to have inflation or deflation? Answer is, I have no idea. It depends on policy. So our job is not to watch the money supply. Our job is not to watch inflation. Our job is to watch policy. What do we want to see? And if we see these things, aha, there we go. That will be inflationary. And if we don't see these things, I don't see inflation coming, which means you probably might have a more moderate disinflation, maybe deflation. However, the Fed is going to keep doing what it's doing and doing more and more and more if that happens. So I really don't see the downside. I don't see deflation, and only inflation if we get certain types of fiscal policy. But before we jump into this, I want to show you fiscal multipliers first, because if you're wondering, well, how did you get to these particular policies? I want to show you what the Congressional Budget Office has published in terms of the fiscal multiplier. All right, so these are important because if we want to have some effect on the real economy, we want to make sure that if we spend $1, we're going to get at least $1 back in the real economy, if not more. If you look at these estimated multipliers, Paycheck Protection Program, 0.36 for every dollar you spend, you get 36 cents in GDP increase. None of them are very good at all. If we look at some of the ones that have higher multipliers, this is 0.4 to 2.2, this is to 1.8. This is payments to state and local governments for infrastructure or for other purposes. Transfer payments to individuals, 0.4 to 2.1. Tax cuts for lower and middle income people, up to 1.5. Not as good as just giving them money or money for infrastructure. If we look down on other policy options, this was from 2010, increasing aid to the unemployed up to 1.9. Employer payroll tax cut up to 1.2. We want to look for some big ones down here. Infrastructure spending up to 1.2 as well. So if we're looking at what the CBO is projecting as having the best in terms of the fiscal multiplier, payments for infrastructure, payments directly to individuals, payments to states for infrastructure as well. So working from that, listen, I can find these numbers. That means everyone's well aware of them. The Fed is well aware of them. Congress is well aware of them. The White House is well aware of them. They all know, they all have this data. They all have the same thing, which means if they're going to do something, the biggest bang for their buck, we sort of know where it's going to be. Other programs, announcing other programs, you look at this one over here, corporate tax provisions primarily affecting cash flows, 0.0 to 0.4. Obviously, it has no effect in terms of fiscal multiplier. It's a waste of money. Anything here that's below 1 would be a waste of money. A 1-year tax cut for high-income people, 0.1 to 0.6. Well, I could have told you that's certainly not going to pay for itself because high-income people are not spending 100% of what they make. So if you give them more, you just give them more savings, more to invest. It's not actually finding its way into the real economy. I mean, did you really need the CBO to actually say that? I think we knew that. Okay, so January 20th onwards, here's what I'd be looking for, especially, now you got to watch Georgia in January, and you got to watch the Senate because it's going to matter. Will the Democrats be able to put things through Congress? If they can get those 2 Georgia seats, there's a higher probability this can happen. Payments directly to individuals. You did have some of that in the $900 billion spending bill that was just passed. But we're going to want to see more of this stuff. Payments directly to individuals, that can increase the multiplier. And make sure it's to mid to low income individuals. There would be no point in sending me any money. What would I do? I don't spend all I make anyway, so sending me money isn't going to do anything. Infrastructure spending, big fan of this one. I think you can't get better bang for the buck on this one. It is the best thing to do because it has a whole bunch of positive benefits going forward. Infrastructure, because you're going to increase demand for materials and for labor, and you increase demand for labor, there is upward pressure on wages, plus employment is higher, more people have more money, right? Materials matter as long as you can have some kind of local policy in place saying, okay, a buy local in terms of infrastructure. This is easy stuff. Easy in the sense that these policies can be done without all of the states having to be on board. What's hard to do? Wages. because all the states have to be on board. There's no point in 10 states raising wages and the others not. Now, you can do it for federal employees, and that would be across the country, and you can have some kind of policy that all federal contractors have to have some sort of minimum wage, but that's not going to benefit the many. That's going to benefit the few. It's not enough. I wouldn't even go there. If you can't get tax, if it's Republican Congress, Republican Senate, you're not going to be able to raise those tax rates again. I would encourage the White House to not raise the tax rates, but then to come up with some policy that makes the labor market tighter. And that could be some kind of localization strategy that then makes imports so much more expensive that you have a lot of companies coming back and making their product for the domestic market in the U.S. because you do have a trade deficit that does have to be fixed. The dollar can do some heavy lifting, but policy really has to step in. If you see this, payments directly to individuals, see more of that going on. You see big infrastructure plans being announced. Doesn't matter what they're building, just build it. That will have a demand for materials and employment. You're going to need more debt. So the central bank is going to have to increase its asset purchases and increase duration of what it's buying, which means it will increase the money supply. But this time in increasing the money supply, if it's going to the government who will then spend it on infrastructure, it's found its way directly into the real economy. This, by the way, is the best strategy to increase velocity. So if you are wondering what side of the bet to make, are we going to get inflation or not inflation, you're going to want to watch velocity, and you're going to want to watch policies that will affect velocity. When you hear those announced, there you go. There you can start saying, aha, we're going to get inflation. Higher inflation and lower U.S. dollar. You're going to have more debt. That's going to put downward pressure on the U.S. dollar. Higher inflation puts downward pressure on the U.S. dollar, especially if the Fed is going to continue to sit on that curve. You start getting higher and higher inflation expectations, you're going to get negative real yields. Well, that'll keep capital inflows out. And there we go. So where do I think inflation is going? It's going wherever policy is going. So if I were going to watch leading indicators at this point, I would be watching policy. What is Biden going to do? And how much ability does he have to get it done? And if he's got the ability to get it done and he announces these things, then yeah, you could see velocity begin to uptick. And if velocity goes up, that price level is going to increase quite rapidly. All right, that's it for this. Next screen is just a technical note on Divizia money supply. Actually, before we get to that last screen, I thought I would just recap where we've been over the last few weeks and what I'm positioning for and the time frames that I'm looking at it. I am positioning for a weakening U.S. dollar. I think into 2023-24, the U.S. dollar continues to weaken. I don't know that the Canadian dollar will reach par again, but I think that $1.15 is not unrealistic. At some point, which is 85 cents on the Canadian dollar or $1.15 on the US dollar. We're 128 right now. I'll be getting that exposure through futures contracts, long-dated futures contracts. Commodities, a weaker US dollar supports commodities right away, so I don't mind being in basic materials or basic commodities in that sense. In other words, not precious metals, not energy, not ag, just really the basic material. And if we do get inflation, well, that's an extra bonus added on. I don't necessarily need inflation, but if we do have some announcement of infrastructure building, then I'm already in the right place. So I'm going to position for it basically on a weaker US dollar. But if these policies show up, and you know what? As I said before, a lot of smart people are involved in this, and they already have this data. This is data I got right off their websites. They already have this data. They know what to do. They know what's going to matter the most. So what would I do if I were in that position? And I'm sure they're probably looking at that saying, well, this is what we need to do. So I don't think that I'm alone in thinking about what has the biggest effect. So if inflation does show up, well, then I'm just already in the right place for it. To capture beta, and because you do want market exposure, synthetics and risk reversals on the S&P 500, but I'm in no rush to put these on. Q1, Q2 I think is a good place to be. I still expect weakness in the first quarter. I think post-Christmas and post-Christmas shopping, post-Christmas gatherings, post-New Year's Eve parties, I think is going to get worse in January. Yes, there's a vaccine. No, it's not in enough arms and bloodstreams right now to make a difference. It is getting there, but it's not there, which means lockdowns. And if you have more of those, that's going to hurt the economy. And every time you have these lockdowns, there are some businesses that will simply just not come back from this. So I think that unemployment is going to be employment will be challenged for a while coming out of this. So I'm willing to wait, but I will have a synthetic exposure to capture beta from the S&P 500, and I'll be using options for that. Good liquid options on the SPY out for as much as a year. Apartment REITs, Q2, Q3, very selective on these, probably not US-based, Canadian-based, and I'll tell you why. And I'll use an example of agency, because I was asked about agency, AGNC, which is a mortgage REIT, how I felt about mortgage REITs, and I feel fine about mortgage REITs. The problem is, and agency has a 9.2% yield, so if you're a US investor and you have room in your registered accounts, beautiful. This is a beautiful, beautiful little earner to have that has some upside potential. But if you're a Canadian and you have no room in your registered plan, and you can't use this in a TFSA because there is no tax treaty between Canada and the US when it comes to TFAs, only RSPs. If you have no room in your RSP, you have to hold this in a taxable account. If you hold it in a taxable account, there's a 15% withholding, which is 1.4% off the 9.2. You're down to 7.8% yield. However, look at here. I expect a weakening US dollar, and this is a US dollar denominated stock, so unless I hedge, I'm going to suffer some downside on the value, on the US dollar value of the stock, which could wipe out the dividend yield altogether, and all I'm left with is any capital appreciation, which might be 10%. It's simply not enough. Now, this 7.8% I get, this is not a qualified Canadian dividend, which means this is income for me, and I have a 53% tax rate. So I lose the majority of that. I end up with a 3.8% dividend yield with Forex risk and maybe 10 or 15% upside over the next year or 2 years. As far as where I stand, it's simply just not a good idea. Most American REITs at this point, for me, are simply just not a good idea. But for a U.S.-based investor, they're still good. So, even though I'm selective on apartment REITs and mortgage REITs, it's mostly because I'm looking in the Canadian market. I don't want to incur any currency risk. And yes, I could hedge it out, but I'd rather just stay local as much as I can for the next little while. Office REITs, not until 2022. Now, I'm not even interested in options, selling puts on these or buying calls on them. I think cap rates are way too low right now, and I think there's probably some negative rent rolls coming up. I think there's negative G on these stocks for the next 4 quarters, 6 quarters, maybe even 8 quarters. Maybe by 2022 I still won't be interested, but I'm going to stay away from that. And retail REITs, no way, you can't drag me into those at all. And alpha, remember I'm getting my beta just from exposure to the SPY. Alpha is where I hope to outperform. Selective names, for example, I mentioned GM I think can outperform the S&P on the upside. Selective names that I feel comfortable owning if I have to own them, where the downside, I think, I could live with whatever downside there is, but selectively. So that sort of just gives you a nice little wrap up. As for now, I'm not rushing in. I'm not doing anything. Yes, I do see the market going up, and I'm not concerned about it. I still think that January is going to be a tougher month than what most people are anticipating. All right, let's look at Divizia money supply. So let's think about M2. And M2 is the sum of all the components, and we'll call the components X and each component XJ. It's the sum of the components that make up money supply. The problem that's pointed out with M2 by simply just adding the components is it assumes that each component is a dollar for dollar perfect substitute as money. So they make the case that, well, just because you increase the money supply, there are some components in the money supply that have an opportunity cost. They're not suddenly going to be equal liquidity with everything else. So you first of all have to determine what an opportunity cost is, and it's denoted by pi jt, component j at time t. And the assumption sort of works like this, that there is some yield that you can get. There is some benchmark yield that you can get with your money. Just because you have money doesn't mean it's going to be available to spend. It doesn't have to be liquid. You could get some yield. And from that, you would subtract the yield on whatever component is associated with it. Some components have no yield, and you divide that by 1 plus RT, and you'll come up with an opportunity cost. I'm just giving you a high-level view. If you want to know more about this, you can actually go to Center for Financial Stability. And if you Google Divizia money supply, you'll find a lot of good academic papers for it. I'm just laying out the argument. So basically, we are taking each component and saying, but there is an opportunity cost to making it liquid. It's not. There isn't a dollar for dollar perfect substitute here. Once we have the weightings, we can determine S. Which is considered, what's a good way to explain it, sort of an expected share that asset would provide towards money supply. And it is going to be the opportunity cost of whatever that component is, multiplied by whatever that component is at time t, divided by the sum of the numerator, because each one is S. This is just a weighting for each component, and the numerator is the sum of all the components and all the weighting, and this is just the proportion of it, which then becomes a weight. This is not a weight yet. It becomes a weighting, asterisk, when you take an average of it. So S j at time t plus S j at time t plus 1, t minus 1, and you just divide it by 2. So it's beginning of the period, end of the period, just divided by 2, because beginning of period, end of period, right? If you have a flow variable, if you take an average, we remember that from FRA when we're looking at income statement and balance sheet amounts. When we have an income statement in the numerator and a balance sheet amount in the denominator, like assets, we take the average total assets over a period. Well, that's all it's doing. It's saying, yeah, this is a weighting, but a better weighting is over a period of time, just divided by 2. So basically, all we've done so far is just get a weighting on each of the components that make up the money supply. And then, this is where I'll probably lose a lot of people, we look at the log of Divizia money supply at time t minus the log of a Divizia money supply at t minus 1. When we take logs and take the difference between logs, what do we end up with? We end up with a growth rate. Right? So this is the growth rate in money supply is equal to the sum from j equals 1 to n components that make up the money supply. And this is where we use our weighting over here, S asterisk for j at time t, asset j at time t. And then you just take the difference between each one, log asset component x at time t minus the log of component x at time t minus 1. Again, that's a growth rate as well. So the growth rate in the money supply is a weighting of the growth rate of each component. That's basically all it's saying, as opposed to saying it's just a simple sum of all the components. It's saying, no, there's an opportunity cost with some of those components. They're not going to be readily available for liquidity. You can't really count that as money supply. And this is expressed in terms of growth rates. High level. I didn't really derive any of these or dig deep into them. If you want to know more, Center for Financial Stability, or lots of academic papers on this stuff as well. That's it.